A very warm welcome to all our viewers to this edition of Cedrus Knowledge Series. This was an initiative wherein we have one speaker each month speaking on a variety of topics, not just finance but also well being. We'll now play a short video to introduce Cedrus Wealth Partners. We have with us today none other than Dr. Anil Lamba. Well, he requires no introduction as such, but for all our viewers, he's a bestseller author, a chartered accountant, a financial literacy activist, international corporate trainer, and doctorate in classic law. Let us play a short video to have a further view of his achievements and his experience. A very warm welcome, sir. And we all are looking forward to your views on your bestseller book, Romancing the Balance Sheet. Without further ado, I will hand it over to Prasanjit Bhattacharya and he'll take this discussion forward. Uh, Over to you, Prasanjit, sir.
Thank you, Nati. Uh, Welcome to this 28th edition of Cedrus Knowledge Series. It's an honor to have you, Dr. Saab, with us on this, particular session. We have had a lot of, speakers who have come before, but none who is a bestseller. So this is indeed a very different kind of a session, and I'm looking forward to having a very different experience this time. Uh, Now, so you have written such an incredible book wherein somebody who is not even remotely connected to the field of finance can also understand profit and loss statement, can understand balance sheet. When did this idea come to you, to write something of this, kind of a wonderful book?
Okay, thank you for inviting me. This echo that is coming, is everybody getting it? Or are you am I quite audible, guys?
You are, sir. You are absolutely.
So romancing the balance sheet was not an idea that came to me. It probably something that grew slowly. You see, I had passed out as a chartered accountant and I decided to start practicing day one onwards. So didn't work anywhere. So when I set up practice, as a new practitioner, you're supposed to be practicing. You hardly have any clients, so there was enough time. And management colleges tend to invite fresh CAs to come and teach finance. That's a good strategy. And earlier on, very few people used to pass, so everybody would know who has joined the gang. So I received an invitation from one of the leading management colleges, and that was the first time the thought came that teaching, I never did CA to teach. But then you realize on cooler thinking that as a professional, it makes sense to teach because it keeps you in touch with your subject. That's how you keep it refreshed. So by applying that logic, I took it on, and then I enjoyed it so thoroughly, Prasanji, that then I took on hell of a lot of assignments. I used to teach in full-time MBA, part-time MBA in every
Hmm.
management college in the town because
Yeah.
remember, I had a lot of time, very few clients. Uh, but then as practice grew, the college teaching became a pain because it comes bang in the middle of office hours. You're sitting in your office, sitting with a client, and you're looking at your watch. I have a lecture, and like it or not, the lecture take priority because 50 people are waiting for you. Then I said,
True.
that's not on. So I started giving up college teaching one by one. But by fluke, by then, some companies had started inviting. Tata Motors, I remember, was my first client, continues to be till date. And then you realize this is even more fun. College people are studying in order to pass exams. These people are studying because they apply it. The funny part is when you qualify as a fresh CA or any degree, you think you are the one who's learnt it now. Everybody knew it before you. You are the latecomer.
Yes.
But then it's a process of discovery how little people understood about this topic. I remember
Yeah.
after corporate training started, and then those days I used to be very active and visible. I was president of this and president of that, social organizer. Then I was writing newspaper columns, and then I was teaching. So as a result, what would happen in the evening? Any function you are attending, any event you are attending, most people would come and ask, when is the next program? I used to not hold the program. I used to only do it on invitation. So when so many people asked me, one day I said, why not organize it ourselves? That's how we also started organizing programs. I was told it's not easy. How will you do it? You'll announce a program, you'll advertise in the paper, you'll book a five-star hotel. Some people may respond, 10, 15 people may respond, out of which 5, 7 may drop out, 5, 7 may enroll, and you'll be left
Yeah.
too few people to hold the program, but too many people to cancel it. Everybody kind of discouraged. It's very difficult. I decided to learn the hard way. We announced the first program, I remember, 1 day program on finance for non finance. I got such a response, I had to repeat it 9 times. I'm still
Uh-huh.
the answer to your question, Prasenjit. I had to repeat that program 9 times thanks to the first program advertising that we did. And then you discover batch after batch, my God, this subject, how is it people don't understand? And then how is it they are so successful despite not understanding? I've had top notch industrialists. I remember the very first batch. This person, I can't name him, this person came and told me at the end of the session, Anil, if I knew all this 20 years back, my life would have been different. And I
Yeah.
thought, possible. This is not possible. He couldn't have been so successful. I thought he is extra modest or something. A little later, next program somebody else said, and the next program somebody else said,
Yeah, it's
and then
mentioned in your book.
I did right, and then I
Yeah.
came to believe I think nobody understands this subject. So,
Yes.
but every time I would hold a session, a workshop, or an in-company program, I realized there are thousands and millions of people who need this. What am I doing? Spending this much energy talking to 15, 20, 30 people. So the desire was there how to take it to a bigger audience. I didn't know how to do it. I wanted to write a book, but I was, I think, too lazy to write one and too busy maybe to write one. So one day I written in the book this also. One day I caught chicken pox. So I was grounded for 10 days. Now I didn't know I was writing a book. I had nothing to do, so I was killing time. So I started putting it down.
Yeah.
So
Yeah.
what emerged at the end of 10 days was this book. So to
Yeah.
answer the question, that's how the book got written.
Yeah, I heard that, I read that somewhere in your book, and in fact, I have also seen that in some of your videos. It was always interesting to know that, in 8 or 9 days' time, when you were sitting back at home, you could finish such a wonderful book, and it's so nicely presented, sir. That's really appreciated.
Thank you. Thank you so much.
So many a times I've seen, I mean, all businesses do have a balance sheet and profit and loss account, which is made at the end of every year. And as you said, very few people have an understanding of, what goes into a profit and loss account and how to read them and how to read a balance sheet. Now, many a times, and it is also mentioned somewhere in your book, and I would like you to elaborate a little bit on this. accounting is kind of confused with balance sheet, a finance, sorry. So when how do you address to that issue, and how do you explain that? I mean, many people think that maybe accounting is finance, and then it becomes too mathematical and cumbersome for them to even go to that topic and trying to understand finance. In this book you have addressed it well. I would like you to also tell our viewers how this was addressed in your book and what you have to say about it.
Two, 3 points. Number one, when I say balance sheet, I don't really mean the balance sheet. I think balance sheet is a generic term to refer to all financial statements. So when I
Right.
say you should understand balance sheet, mean not just the balance sheet, that covers P&L and balance sheet and cash flow and fund flow statements and everything that goes with it. But I completely agree with you. There is a huge misconception in people's mind. They confuse the subject of accountancy with the subject of finance.
Finance, yes.
Now, accountancy is the process of preparing these statements, whereas finance involves the ability to understand, interpret, read, make sense out of these. I've always said you can spend your lifetime saying, I don't know how to make a balance sheet. It doesn't matter. But if anybody says, I don't need to know how to read a balance sheet, that person will pay a price. Anybody who runs a business has to learn how to. I have always said this is the language of business. If you
True.
don't understand the language of business, you will not understand what your financial statements are trying to tell you. They're speaking with you all the while. You take your
True.
pathology blood test reports to a doctor, doctor looks at the reports and knows what's wrong with you. Similarly, these statements what tell the business person, the entrepreneur, the owner, what is right or what is wrong with the business. Because if you don't read the signs, you will know your business is in trouble after the trouble has probably reached somewhere here or something.
True.
And because people think financial accounts, they stay away from the subject. They think it's not my job. Guys, I agree, accounting is not your responsibility. Keep somebody to handle accounting. But the buck stops with you so far as finance is concerned. And if you're a business owner, this is one subject you should learn, you should master at the earliest opportunity, and you will reap the benefits of that. There are two, three misconceptions. Number one, they think finance is boring. Now, I can't understand when somebody says finance is boring, I say, I'm talking about money. How can money be boring?
Money be boring.
But they
Yes.
misunderstand accounting. Accounting is boring, I agree with you. But finance is one of the most fascinating. Number two, people think finance is complicated. It's a difficult subject. I think there isn't a more common sense subject that exists. I mean, anything that I teach in a class, I say, even if you didn't come here to attend my session, if you sat in a room and meditated about it, you'll reach the same conclusions. Is that common sense a subject? But
Yes.
these misconceptions keep people away from it, and the price paid is not funny. So I seem to be on a mission to try and take this literacy top to bottom to everybody. We do it commercially. We have a social project called Financial Literacy for All, which is an attempt to train 1 billion Indians free of cost. We do it through live sessions, we do through online sessions, we do through videos, we do use e-learning, we use books, any medium possible, any which way. But the idea is so that it can reach to people with any kind of a budget. A book
True.
costs the financial literacy program is free, whereas other programs can go into lakhs and crores. So depending on where you come from, nobody should stay away from an understanding of the subject. That is one message I think that should go out loud and clear.
So, in your book, you have many a places you have mentioned that anybody who has something to do with any business should actually read this book and understand, this book so that he can take some informed decisions going ahead. Now, how does this book address to an investor uh, who is managing his personal wealth in his individual capacity? So does he also need to get some, he also gets some benefits by reading this book, or is there a different way to address that?
You see, an investor and personal finance people do not make a profit loss and balance sheet, and therefore some of the things may not be directly relevant, even though an understanding of finance can never go waste. But for those people, I have other books. I have a book on stock market called Flirting with Stocks. I have a book on personal finance called Financial Affairs of the Common Man. And there, the relevant stuff I have taken from this book also. So a little bit of understanding of balance sheet is reproduced over there. Focus purely on the investor, I have other books. So if a
Okay.
business person will read Romancing the Balance Sheet, that person would find it relevant first page to the last. In fact, many things are not covered, which are covered in my next book called Eye on the Bottom Line. Whereas a person for the personal finance requirement reads it may find 15-20% relevant. Other things may not be directly relevant for personal finance management.
Right, sir. Right, sir. So, Unnati, do we have any questions which have started to come in?
Yes, sir. We have some questions from the audience which we started to come. Uh, so one question which I want to ask is, how can businesses use the concept of working capital to manage their cash flows more effectively? And what are some of the strategies for optimizing work capital?
Okay, interesting question. Who asked this? Is there a name? Okay. What is working capital? You see, if I ask you to visualize a balance sheet, one side of the balance sheet, the liability side, tells you where the money came from. Business raises money from principally two sources: owners contribute and outsiders contribute. Owners' contribution being called equity and outsiders being called loan. And this money goes into two avenues. If you're running a business, it partially goes towards setting up your infrastructure. If you're a manufacturing company, you will need land, building, plant, machinery, and so on. But one should make sure that you don't exhaust your resources in the process of creating infrastructure alone. One has to make sure once infrastructure is set up, there is still money left behind, because you will now require a continuous supply of something known as working capital. So why do you need working capital? Imagine you are manufacturing a product. Once you buy land, building, machine, you got to make sure there is more money left, because let's say next day a customer walks in and says, I'll give you an order of 100 crores. Now, in that 100 crore order, first of all, strong chances are if you get an order, you're lucky enough. That order is not going to come along with a check of 100 crore in advance, unless you're an exceptional kind of a company. Now, you got this order of 100 crores. To execute it, you probably need raw material of 60 crores. And if you don't have the money left for that, how will you execute the order? So, the first requirement of working capital is to have the financial ability to invest in addition to infrastructure, also raw material. And prudent business people will not buy raw material after a customer is walked in. They'll probably buy and maintain an inventory of raw material. So, inventory being the first requirement of working capital. Now, this 100 crore order will take several weeks, several months to execute. But in the meantime, expenses are there, salaries have to be paid, rents have to be paid, overheads have to be paid. So you got to hang on to sufficient amount of cash and bank balances also. So second component of working capital. And the third component is business reality is, after spending 70, 80 crores, you invoice this your goods to your customer for, let's say, 100 crores. And the customer says, thank you very much, come and collect your check 30, 60, 90 days later. So not only you don't get advance, but sometimes even on delivery, you don't get money. So you got to finance your customers also. That is debtors. So three components of working capital: raw inventory, cash and bank balances, and debtors. Now, this entire cycle, working capital can be depicted like a cycle. It is either called the working capital cycle or it is called the cash to cash cycle. So in a manufacturing company, the cycle begins with cash. Then you spend it, buy raw material, it becomes inventory. Inventory goes into production process, it becomes a finished product. For the finished product, you find a customer, it becomes debtor, receivable, and when you collect money from the debtor, it comes back in the form of cash. This cycle is called working capital cycle or the cash to cash cycle. And one of the tricks of good finance management is your ability to shorten the cycle. Now, since there's no
Interesting.
present, you got to visualize along with me. Imagine there are two people who go to a bank asking for a loan. Both of them say, "Banker, I want 100 crore loan for working capital." To the first person, the banker asks, "Why do you want this loan?" He says, I got to maintain inventory. Banker says, "What kind of inventory would you like to maintain?" This fellow says, "It should never happen that there are orders on the shop floor and no raw material. I want to, on the safe side, hold on to raw material inventory of 3 months." Then his inventory goes into production process. This fellow says, "I am an international player. My product has to be of global standards. So to make sure I don't compromise on quality, I must spend at least a month to convert raw material to finished product." So how much it has happened now? 3 months of inventory. 1 month you took it to convert to finished product. Then this guy says those days are gone. Where a customer used to come and I could afford to tell the customer, "You want to buy from me? Do one thing. Give me an order, give me an advance, and take your stuff 2, 3, 4 months later." In India, Bajaj Auto at one time used to take an order, take booking advance, and deliver scooters 5 years, 7 years, 8 years later. That kind of waiting period you have. Those days are gone. Today's customer expects finished goods lying on the shelf. So this guy says, "I have to hold on to a finished goods inventory of 1 month also, so that when the customer comes in, I can tell him, take it right away." And this guy says, "I'll be a fool if I think I can tell the customer who comes to me that you want to buy from me, pay me cash upfront. Otherwise, go away." Now, customer will go away. He goes to my neighbor. Neighbor says, "Take it, pay me after 2 months." Now, the neighbor is going to offer him a 2 months credit. When will this customer come to me? Only if I offer him a 3 month credit. Tell me, how long will his cycle take? He's got 3 months of inventory, 1 month of production time, 1 month of finished good inventory, and a 3 month of credit. It takes 8 months. So how many cycle will he achieve in a year? One and a half. So 100 crore invested will probably generate a turnover of 150 crores. Now let's imagine this guy's got a neighbor who also goes to bank. "I want 100 crore working capital loan." Bank says, "Why?" "I want to maintain inventory." Banker says, "What kind of inventory?" Now, this guy not only understands he needs inventory. I have a mantra which says, "Less is bad, more is worse." This applies across the line. So this guy says, "Of course, I need inventory. But why 3 months?" He says, "How much inventory I need should not be a figure that comes out of my hat." To understand the need for inventory, he says, "What I'm going to do, I will first do a sales forecast. Based on that, I will do a production forecast. Based on that, I will do an inventory need analysis. Then I'll have meeting with suppliers to see that I can reduce the lead time between placement of order and receipt of material. Ultimate intention," he says, "is I have to head towards what is known as just-in-time inventory." But he says, in the meantime, I can manage with 1 month. Inventory reduced to 1 month. Now, when his product goes into production cycle, he says, "I am also international player. I understand importance of quality, but I don't agree that the longer the time taken to produce, the better the quality. I can probably cut down my production time from 30 days to 15 days and still make sure I don't compromise on quality." He says, "Finished goods inventory up to 15 days enough." And when customers come to buy, he says, "I don't agree that the single yardstick used by customers to buy or not to buy is the period of credit. They look at so many more things. They look at my product quality. In certain cases, they see my packaging quality. They look at my pre-sale service. They look at my after-sale service. If need be," he says, "I'll offer them a slight discount, but I will convince my customers to pay me within a month." Tell me, how long does his working capital cycle take? 1 month inventory, 15 plus 15 days processing and finished goods, and 1 month credit, 3 months. How many cycles will he achieve in a year? Four.
Wow.
Two fellows borrowed 100 crore. First fellow borrowed 100 crore, generated a turnover of 150 crores. Second fellow borrowed 100 crore, generated a turnover of 400 crores. This is the
Correct.
power managing working capital. Now, do you
Yes.
agree that constitutes good finance management? Of course, this is. Tell me, who are the people involved in this practice of good finance management? Do you see a single person from the finance department? How much inventory to buy is a decision taken by the purchase manager. The
Correct.
production time was taken by the production guys. The
Correct.
sales at lesser credit was handled by the sales guys. Each of this person, Prasanjit, ironically calls himself or herself non-finance person. What a ridiculous notion, non-finance person. Not a single person in an organization is a non-finance. I always say, at the cost of running down my own community, is that the only non-finance person is the person who says I'm a finance person. That guy is not there anywhere in the picture when profit is being generated. He comes into the picture after everything is over, does a post-mortem and tells you whether the company has made a profit or not. So,
Cutting all the
hmm,
sorry, cutting all the jargons, I think you have brought it up very nicely in the book. The same thing, So it was very interesting to read those pages, So which you are now elaborating so nicely.
so the point is, unless financial literacy goes top to bottom,
Yes.
an organization finance management cannot be at its peak.
Yeah, it is everybody's job on the shop floor. So I have a question, especially considering the current situation. What are some of the strategies that companies can use to overcome a credibility trap and restore investor confidence?
You've gone to a chapter that is not of credibility. That is a little dangerous area I've gone into. You see, what happens is, now that you asked this question, I'll try and simplify it as much as possible. A healthy organization, one of the things it has to make sure is that its current ratio is positive. Current ratio positive meaning, on the asset side you have debtors and bank balances and all, and on the liability side you have creditors. Those debtors, etc., should be higher than the creditors. Otherwise, you get into an insolvency like situation. But I was pointing out that a credibility trap is, the more credible you are, the more likely you are to get into this trap. Because if you are, what should happen for you to be out of this, to have a positive current ratio? If you sell on credit, if you have enough bank balance, if you maintain enough inventory, current assets will be more. And if you buy on less credit, current liabilities will be less. But the thing is, the more credible you are, the more vendors are willing to give you credit because they want to be a vendor to you. So they compete amongst themselves. One vendor says, buy from me, pay me after 2 months. Other guy says, pay me after 3 months. Other guy. So you tend to buy from the vendor who gives you the longest credit. So creditor's side, liability side goes up. And if you're a strong player, you have no problem in selling. If you tell your customer 1 month credit, they buy. If you say cash payment, they'll still buy. So your debtor side can come down. So the more credibility you enjoy, the more likely you are to get into this trap. So my point is, if the vendors are offering you credit, doesn't mean you accept it. You should know where to draw the line and say, vendor, thank you very much, but I don't want. Because otherwise the ratio will go haywire. But this needs a far more elaboration with the help of a presentation in front of me. So
Yeah, I understand, sir. I understand, sir.
very impressed, Sandeep. You seem to have read the book corner to corner in a short time. Amazing. Amazing.
Thank you so much, sir. Unnati, are there any questions on, the audience side?
We do have, and the next question which I'm going to ask sir is a very interesting question. Um, Many large families invest in real estate and lack liquidity in case of any adverse event. What would you advise these families on how to maintain their cash flows and keep a balance?
Families.
Yes,
This is from a personal finance thing, no?
this is a personal finance question. Yes.
I mean, family's liquidity need is different from a company's liquidity.
Companies need.
That's clear.
Yes.
Families are means you got to have a regular, of course, stream of income to take care of your day-to-day expenses. And it is only for stuff like pandemics and stuff like that, and different thumb rules come in, or particularly if you are in a job and employment. So thumb rules vary from 6 months to 1 year. Enough cash you should hang on to so that your house
Emergency
doesn't.
corpus.
So Finance, fortunately, is a very easy area to get into. The real finance management that is required is when it comes to business finance.
So, any business finance question, Unnati?
Uh, uh, Moving to that business finance question is there is one question on that. Dividends are released from the retained earnings of a company. A corporation has a large balance in their retained earnings. So, does that mean that dividends to shareholders will be increasing?
Yeah, you covered this in a video, sir. I remember you covered this in a video.
And a wrong interpretation. Dividends are not given from retained earnings. The retained earnings are earning left behind after giving dividends. And a lot of people make the big mistake of thinking when they see reserves in a balance sheet, they think, oh, this company is sitting on piles of cash. In fact, why did reserves get created? Because they didn't have cash. Imagine a company makes 1,000 crore profit and they give away 200 crore as dividend and 800 goes to reserves. Why did they give 200 crore as dividend? Chances are they gave 200 as dividend because the money they could muster was only 200. Because one of the paradoxical things in business is profit doesn't mean money. In fact, they have an inverse kind of a relationship. So if a company makes a profit of 1,000 crores, doesn't mean they have a bank balance of 1,000 crores. In fact,
True.
let me put it that way. If they had a bank balance of 1,000 crores, chances that they wouldn't be making a profit. So you don't make money by keeping money in the bank. You make money by deploying it effectively. Now, you made a profit of 1,000 crores. You could only manage to gather 200 crores, so you gave a dividend of 200. So, how did reserves come about? Do reserves represent cash? In fact, reserves were created precisely because there was no cash. See what a paradoxical situation it is.
Sorry.
Absolutely wrong question to think. First statement was wrong that dividends are given out of reserves. No. Number two, theoretically, this is correct. In future, you see, law says you can't give dividends except out of profit. But the law says profit need not be current year's profit. You can make losses in the current year and still give a dividend, provided you have undistributed dividend lying in undistributed profit lying in the form of reserves. But my point is, even in the year in which they made a profit, they had a problem getting the money to pay dividend. It's highly theoretical. In subsequent years, they have losses, but they're using reserves to give dividend. So, in my opinion, once profits go to reserves, they become almost as permanent as share capital. And if at all reserves are used, they are used to distribute bonus shares, where from an almost permanent category called reserves, they jump to a totally permanent category called shares.
Very interestingly put up and different perspective you've given us, sir. My next question to you is, how can one spot any fraudulent or related party transactions, like in Adani? How can one spot that through the company's balance sheet
You have
and
to deep dive into the balance sheet. That, of course, answer can be. You need a complete understanding of these statements. Once you start deep diving, things will come.
right, sir?
And people don't have to do it themselves. That's why you have auditors and stuff like that. Unfortunately, many auditors don't do their job conscientiously. That is why these questions come up.
Okay, right. And going forward to the next question, sir, how can investors use their understanding of a company's balance sheet to identify any potential acquisition or investment opportunities? And what are some of the risks or benefits associated with these decisions?
Long, short question. Long answer. I don't think these questions can be answered in 2 minutes. But an investor should read the balance sheet if they want to. If there are people who are selecting stocks, picking their investments, if they don't know how to read balance sheets, so here is where an ability to read balance sheet comes in handy for people investing. Also, let me give you a little input on something called leverage analysis.
Mhm.
Leverage. People, the world interpret leverage in a very narrow sense. When you talk about leverage, they think we're talking about just about loans, but leverage is a far bigger word. Leverage means, it comes from a word called lever. Lever is an engineering device. It's a mechanical device, engineering term. If whenever you want to lift a weight, you take the help of a lever, the effort that you exert at one end is less and the weight that you lift at the other end is more. We are talking about financial leverage. If you have to double your turnover in order to double your profit, you are doing sheer hard work. There's no smart work involved. But if you take the help of leverages, you increase your turnover 10% and profit goes up 40%, 60%, 80%. That is the leverage effect. Now, what causes leverages? It is caused by the presence of fixed costs in your costing structure. Now, I'm cutting it short. Fixed costs are of two types. There are some fixed costs associated with your operations. So you have no control over them. That's by virtue of the operation that you do. But there are other fixed costs based on the way you fund your business. And that is interest. So if you fund it
Yes.
primarily by equity, there is no interest component. But if you take debt, there is interest. So operating fixed costs give rise to operating leverages. Financial fixed costs give you financial leverages. Now, if you want to choose a company and decide, understand what kind of risk are you taking? You ask about risks associated with it. A little bit of leverage analysis will give you an insight. There are companies that could have a high operating leverage and a high financial leverage. Second category would have low. Third category could have high operating, low financial, and the fourth possibility is low operating and high financial. There are only 4 types of companies. And operating leverage is not in your control because those fixed costs are dictated by the nature of business. That means if that is a given, your financial leverage should be a choice. So if you come across a company which has got both high operating and a high financial leverage, that is the riskiest investment you can make. Leverage gives you an advantage when things are going your way. When sales goes up slightly, profit gallops forward. But the reverse also works. When the sales drop slightly, profits come sliding down and you can go into the red. And the highest possibility of this happening would be with a company with both high, operating high, financial high. So if you find a company making tons of profit, now there are two types of people who might invest in it. One who is impressed with the profit. Second fellow does it having done leverage analysis. What's the difference? The person who did leverage analysis and then bought the shares of a profitable company, that fellow knows I'm taking a risk. And then that fellow watches the share like a hawk. And while the going is good, stays invested. And the moment the turn starts, is the first person to get out of the company. Anybody who bought the share just by being impressed by profit, not knowing the leverage involved, next time will remember I hold these shares when he's reading a news item that this company is gone fat or something. Second is both are low. That is the safest investment. And I suggest don't even buy the shares at all. You'll make more money giving them as FD or something. Third is the category who's got a high operating leverage and a low financial leverage. The high operating leverage is by virtue of your condition because you have operating fixed costs. So this looks like a company that has consciously decided to curb borrowing because you already have a high operating leverage. You're going to enjoy the benefit of leverage. And the only way you can manage the risk is by keeping your financial leverage low. And the best combination, according to me, is a company that has a low operating leverage. Low operating leverage means those fixed costs which you're forced to bear by virtue of your operations are less. That means it tells you the break-even point of this company would be quick. That means even during recessions, surviving is not a problem for this company. And in happy days, if they want to increase the pace of growth, then all they have to do is, in addition to their own money, they can take a generous dose of borrowed money and the profits can go rising at a faster pace. And still, they will not become a risky proposition because the risk that financial leverages brings with it is offset by the safety of the operating leverages. So I would urge your people, those who invest in shares, to do well, to understand this concept. This will give you a very, very different insight into your investment decisions.
Dr. Lamba, this romancing the balance sheet is perhaps the easiest way to learn the finance management. And the way it is written, it's so jargon friendly, user friendly, and anybody who has done nothing of finance can also read and understand it. It's in such a poetic manner. It's written with all the quotations and boxes and highlights and all that. We really want to congratulate you to bring forward such a book, such a beautiful book which everybody can use and can become learned on the part of at least the balance sheet reading or anything to do with a business. They can at least have some idea about how the businesses are run. um, Unnati, if we have any other questions, or you think we can, do we have
That
any
was
questions?
no, that was it from our answer. I think Sir explained the concepts also really in a very beautiful way, and the leverage
In
part of
fact, sir, if you
finance.
ask me, I'm just interrupting there. I'm sorry for that, Unnati. I think, sir, when I listen to you, when I hear you, even on a podcast or on YouTube, it is such a pleasure, and I feel that let it continue for some more time. So it's always you're such a wonderful speaker, and you the way you present for all the concepts so easily for anybody to understand, really commendable, sir. And the short session is actually not so satisfying for a person who would love to hear you so much. So
Thank you.
yeah, so Unnati, please, I thought I just placed that comment there. Yeah, please.
No, I would absolutely agree with Prasanjit sir. Your views, your perceptions, very very well laid down, and thank you so much, sir, for your time to grace this event. And I'm sure the whole team of Cedris and our viewers have got a lot of inputs from your points which you mentioned. Thank you
Thank
so much for coming in and giving us these beautiful pieces of
Thank you for
inputs.
inviting me. It was a pleasure. Thank you.
Likewise, sir, it was a pleasure and honor to have you today with us.
Likewise, sir. Thank you so very much for your time, sir.
Thank you.
Thank you, sir.